Good afternoon, ladies and gentlemen, and a warm welcome to our webinar, Income Taxation for U.S. Citizens and Green Card Holders, brought to you by IDB Global Federal Credit Union. Our presenter today is Dale Mason, and with over 25 years of experience in international tax consultancy, he developed his international tax expertise while working as an expatriate tax technical expert, that's a lot of words, in KPMG's Washington National Tax Office. Additionally, while building and directing Central Europe's largest expatriate tax practice for PwC, Dale developed a keen understanding of the issues surrounding living abroad and the significant international tax and financial problems that expatriates face. Dale earned his BS in economics with an accounting emphasis from the University of California at Santa Barbara. So I have to share a fun fact about Dale today before we begin. He loves to sing karaoke, especially Elvis Presley impersonations. But before we start, a few reminders. I want to make sure that everybody knows that this webinar is being recorded and all registrants and attendees will receive the recording as well as the presentation material via email. If you have questions for Dale, please use the Q&A tool to type your question and he will answer them after the presentation. So you'll see that tool at the bottom of your screen. If feedback, and your feedback is really important to us, so please kindly fill out our survey that we'll be sending via email after this webinar. And additionally, I'll be posting the link in the chat tool at the end of the webinar as well. Thank you everyone for joining us. I know we have a lot of people who are really excited about this presentation. And Dale, I pass the baton to you. The floor is yours. Thank you.
Thanks very much, Marilyn. Let me just do a little bit of Elvis with my lip. And that's about all I have today for Elvis. So today we're going to be talking not about Elvis, but instead we'll be talking about taxation of U.S. citizens and green card holders. So if you are here today, you should be a U.S. citizen or green card holder, or you may be a G4 visa holder wanting to listen in to see what you're getting into. The U.S. citizens and green card holders can tell you that the U.S. tax system can be enormously complex. But today we're going to go over some really fun things with regard to U.S. tax, specifically for IDB employees or retirees and their spouses. And we'll get going. So next slide, please. So why do I have a disclaimer? The reason is not so because I'm going to say anything incorrectly. The reason, of course, is because the U.S. tax system, as I just mentioned, is absolutely the most complex tax system in the entire world. Usually, there's the general rule, then there's an exception to the general rule, and an exception to the exception usually. So today we may just get to the general rules and not the exceptions or exceptions to the exception. So that's why I have the disclaimer that says, please seek professional tax or legal assistance based on your own specific set of facts and circumstances. This is very important. Don't just take what I'm going to say today and run off and try to do some tax planning because you're bound, because of the complexity, you're bound to make a mistake. So please always seek your own specific professional tax advice. Next slide, please. What's the most important thing to understand when you're first, especially those G4s that may be on the webinar here, and you're thinking about staying in the United States and obtaining a green card? What's very important to understand is tax residency. And that's what we'll be going over next, some tax residency issues. Next slide, please. Okay, so who is a tax resident in the United States and why does it really even matter? If you become a U.S. tax resident in the United States, you will be subject to full worldwide taxation, and we'll get to what that means in a moment. But people who are tax resident can either be U.S. citizens, U.S. lawful permanent residents, in other words, green card holders, or people who meet the substantial presence test of residency. Next slide, please. So it's very obvious when you become a U.S. citizen, and it's obviously very obvious when you get a green card that you're now a U.S. tax resident, you're a U.S. person. But people who need to understand whether or not they've met the substantial presence test of residency are those people who are probably G4 visa holders working for the IDB, and they're about to retire. When they retire from the IDB, their first day of presence that actually count for tax residency purposes is their first day of freedom, the first day of retirement. And those days then, while they're waiting for their green card, if they decide to stay in the United States and wait for their green card, will be counted for purposes of tax residency called the substantial presence test. Now, the reason that G4 visa holders are generally not subject to tax residency, they are not tax residents, is not because the US tax system or the IRS Internal Revenue Code says anything about G4 visa holders. It doesn't say anything about G4. As a matter of fact, what it does say is that days in the US by reason of full-time employment with an international organization are exempt from counting for purposes of the substantial presence test of residency. So if you're a G4 or G4 dependent, your days simply don't count. It's like you're not even here. And that is why you are generally speaking, not a resident of the United States. But then when you retire, then the first day that you're no longer a full-time employee of an international organization, the IDB, then your days of presence do start counting, and you could become a tax resident, generally speaking, after 183 days based on a formula. Next slide, please. So this is the substantial presence test formula. I won't go over it in detail, but generally speaking, if a person retires from the IDB, let's say April 1st, and they remain in the US the entire rest of the calendar year, waiting for their green card, well, from April 1st to December 31st is well over 183 days. So they become a tax resident beginning April 1st, the first day in the US, where they were no longer a full-time employee of the IDB. And therefore, you can become a tax resident if you're a G4 visa holder in the year of retirement under the substantial presence test, because you would have gone over the magic number of 183 days in that calendar year. Next slide, please. I want to go over again, this is so important because there's so many people that don't understand this rule and simply neglect to file a proper US income tax return reporting their full worldwide income. To reiterate, if you are a US citizen, a green card holder, or another visa holder that has met the substantial presence test of residency, you are a US person for US tax purposes, and your entire worldwide income, no matter where that is derived, is reportable on a US income tax return called a Form 1040. So you say, well, Dale, that doesn't seem to be fair. What if I'm from Colombia, and in Colombia I have a rental property, and I'm earning money on that rental property, and I have to pay tax in Colombia on that rental property. Surely I don't have to report that to the United States government. Yes, unfortunately you do. You'll always report all your worldwide income to the US government. However, you're likely not to have to pay tax. This is the last little bullet point on this slide. You probably will not have to pay double taxation. Instead, what you'll receive on your US income tax return is what's called a foreign tax credit. So you will get credits for taxes you pay to foreign countries based on the income that you derive there. You always have to report the full amount of your worldwide income on your US tax return, but generally speaking, you'll get a foreign tax credit, which will eliminate the double taxation. However, that's not the case when it comes to the states, and especially DC, Maryland, and Virginia. They generally don't allow foreign tax credits. So to give you an example, let's take my example of you have a rental property in Colombia, and you're taxed on that rental income at a 30% tax rate. And let's say in the US, that when you report that on your US income tax return, your effective tax rate is only 20%. Well, you're not going to pay 50% tax on that rental property income. Instead, you'll get a foreign tax credit, and the way the calculation works, generally speaking, you're just going to have to pay 30%, not 20, not 50, but 30%, the higher of the two tax rates. However, if you live in Virginia, then you don't get a tax credit on your Virginia tax return for that income that you have to report from Columbia. So you'll pay the 30% tax rate in Columbia and the 5.75% tax rate for Virginia. So you will have a double taxation issue when it comes to the states. Next slide, please. Okay, we briefly mentioned the Form 1040. And U.S. tax residents, if you're new to the Form 1040, if you've just recently retired, you were a G4, and now you have to deal with the U.S. tax system, you will be filing a Form 1040. And the Form 1040 will generally be due on April 15th. So for 2020 taxes, you will have to file a prepare a tax form, Form 1040, and send it in on or before April 15th. Now, there's been some delay, and obviously because of the pandemic in 2020, they gave us an automatic extension of time to file the Form 1040. But so far they haven't done that, although there is a definite delay in IRS processing of tax returns. So I believe it's either the 12th of February or the 14th of February where the IRS will start accepting e-file returns. So just note that, and maybe we'll get another extension, who knows. But right now, as it stands, you have to file your returns before April 15th. Now, if it's April 14th and you haven't filed your tax return yet, don't panic and don't try to stay up until midnight trying to prepare your tax return, because you obviously may make a mistake if you're worn down and you try to do it at the very last moment. Instead, what you should do is you should file a Form 4868. Now, the 4868 will extend the time that you have to file your tax return. It doesn't extend the time that you actually have to pay tax. So what you have to do is make a calculation before you extend your return to see if you owe any tax and pay the tax before April 15th, although all the paperwork can be done as late as October 15th if you extend your tax returns. And of course, states also, Virginia, DC, Maryland, they will also allow for an extension of time to file your taxes. Now, when it comes to the taxes, the US government doesn't like to receive all their taxes at the end of the year. They want to receive those taxes from the taxpayers basically in 4 quarterly installments. These 4 quarterly installments are called estimated tax payments. And for those of you who are US citizens working for the IDB, you know, of course, that your compensation from the IDB is taxable, but the IDB, given that they're an international organization, they don't have any responsibility to withhold any taxes and pay it over to the federal or state governments. Instead, it's up to you to pay those quarterly estimated taxes yourself, excuse me. And when you retire from the IDB, obviously at that point, you'll be a green card holder or US citizen. When you receive those pension payments from the IDB, you will have to make quarterly estimated tax payments also beginning April 15th. Next slide, please. So again, I just wanted to make sure that all the US citizens, especially if you're new to the IDB and you've just been recently hired by them, you have to understand that the international organizations, including the IDB, again, they don't have any responsibility to pay over any taxes to the US government. So they don't have any responsibility to withhold federal taxes, no responsibility to withhold state taxes, and no responsibility to withhold Social Security taxes. Now, most of you G4s and green card holders on the call will know that G4 visa holders and green card holders who are working for the IDB are completely tax exempt on their wages. But that, of course, is not so with regard to US citizens. So US citizens, since they're taxable on their wages as they work for the IDB, you will have to make these quarterly estimated taxes for the federal government and the state government, whatever state you live in. as well as, this is very important, as well as US Social Security taxes. Now, if you worked for an employer that was not an international organization, this would all be handled for you through withholding, and the employer would pay it over to the US government. So with regard to Social Security taxes, the only mechanism that the US government has figured out that would be acceptable to them in paying over the Social Security taxes that US citizens working for international organizations owe is through the use of Form SE, the self-employment tax form. But just because you're a US citizen completing the Form SE to pay over your US Social Security taxes doesn't mean that you're self-employed. The IRS for many years now has been looking very carefully at international organizations, the tax returns by their US citizens that have been filed. And many, many times they see that US citizens, because they're using the self-employment tax forms, think that they're able to take self-employed type of tax deductions or make self-employed type of pension contributions. That's not so if you're an employee of the IDB and you're a US citizen. Again, this is just paying over the Social Security tax with your Form 1040 on Form SE, the self-employment tax form, is just the only mechanism that the government has figured out for US citizens to pay over the Social Security tax when they work for international organizations. So don't forget that form. And also, it's interesting to note that if you, during the calendar year for 2020, if you're a US citizen and you were employed by the IDB and you worked for them abroad for any time outside of the United States, that the work performed outside of the United States is still taxable for US income tax purposes, but US citizens who are employed outside the United States, the compensation for that work performed outside the US is not subject to self-employment tax. So you can actually reduce your self-employment tax by allocating the amount of the compensation that you earned during 2020 to that amount that was for work performed outside of the United States. So that is a little tax saving potential tip for you if you're in that situation. Next slide, please. Okay, some recent income tax changes. Now, they're not really a huge amount of income tax changes. The last time we had income tax changes, of course, was the Trump tax reform that came into effect in 2018. Now, it's very, very likely that President Biden is going to probably make some additional or propose some additional tax changes in the near future. Generally speaking, he says that, President Biden says, that if you're making income of less than $400,000, your taxes really should not change. It's only those people who are making in excess of $400,000, they may have an income tax rate hike, and you may have to pay more income taxes if your income is more than $400,000. We don't really have much of any details yet, and my guess is because of the economy and the way that President Biden is proposing these things, it may not occur, the tax law may not change perhaps until 2022. I doubt that he's going to make any proposals that will be retroactive in 2021. Next slide, please. Okay, so those of you who got economic impact payments, also called stimulus payments, are probably wondering, did I receive enough? Maybe I shouldn't have received this stimulus payment. And I'll go into that a little bit. So if you are a US tax resident, again, the US tax resident means US citizen, green card holder, or a person who has met the substantial presence test of tax residency in 2020. By the way, it will also include a G4 visa holder married to a US person who has filed a joint income tax return with that US person. That person that's a G4 that's filing that joint tax return would also be considered a U.S. tax resident. And for 2020, as long as you're not considered or eligible to be a dependent on someone else's return, and of course, this is usually children that we're talking about or students, and that's not going to apply to people on the call today. And as long as you have a Social Security number, you should be eligible for the stimulus payment. And maybe you got one, or maybe you haven't received one. Maybe you were, who is not eligible are non-residents in 2020. So if you were a non-resident in 2020, but a resident for 2019 or 18, when issuing these payments, the federal government would have looked at your 2019 or 2018 tax return and said, oh, the person is a US tax resident. So you will then may have received a stimulus payment. But because you were a non-resident in 2020, you're supposed to give that payment back. There, if you just Google online of giving back my stimulus payment, then you'll find how to do that. Whether you've cashed the payment or not, it tells you all about what to do if you have to give your stimulus payment back. But generally speaking, it would really, most of the time, it's only going to be for people who were residents in 2019 or 18, but became non-residents in 2020, but still got the stimulus payment. That you may have to pay it back. Now, there was phase outs when the government issued these checks or direct deposits. There's a phase out range, so people may not get the full amount of stimulus payment if they were single and they made over $75,000 of adjusted gross income, or if they were married filing joint and they made over $150,000. Then there may have been a phase out, and you may have been given a lower stimulus payment, depending again, when the federal government was issuing these payments, they looked at 2019 tax returns and 2018 tax returns. But remember, the pandemic didn't hit until 2020. So generally speaking, the 2020 return, your tax return, is really what's going to count. Next slide, please. So what happens if you were, for example, a non-resident in 2019 and 2018, and now in 2020, congratulations, you've become a US tax resident. And because what I said is these stimulus payments are meant for people who filed a 2020 resident tax return, and your stimulus payment really, for the most part, is based on your 2020 income. If you were a non-resident in 2019 and 2018, you probably didn't get a stimulus payment because the U.S. government looked in your file and didn't see that you were a resident, so they didn't issue you one stimulus payment. But for 2020, if you've become a tax resident, now you deserve a stimulus payment. And the way they handle this is through an economic impact credit. So on your 2020 tax return, if you didn't get the appropriate amount of stimulus payment, then for 2020, you can claim a credit for the amount that you're due. Now, if your income in 2020 went very high so that you were phased out of supposedly receiving an economic impact payment, but based on your 2019 return, you were a US resident. In 2018 return, you were a US resident. And the federal government used that income, but you're looking now at 2020 and you say, oh, I should be phased out. If you got a stimulus payment under those circumstances, you don't have to pay it back. The only time that you really have to pay a stimulus payment back is if you're a non-resident for 2020. Next slide, please. Do you see what I mean about the US tax system being the most complicated in the world? Now, here's something not so complicated. What changed in 2020 and what's eligible for your 2020 income tax return is if you've made cash contributions to charitable organizations or churches or religious organizations in 2020, you will be able to get either a $300 deduction if you're single, Or if you're married filing joint, you'll be able to get a $600 deduction on a married filing joint tax return if you don't itemize deductions. If you do itemize deductions, then of course you would just include those contributions as part of your itemized deductions. But many people these days, and you and your tax accountant can look at this, but to determine whether or not you are taking the standard deduction, it's called, or itemized deductions, you get the larger of the two. So for example, the standard deduction for 2020 is $24,800. It's at this level, $24,800 if you're married filing joint. If you itemize deductions such as property taxes, home mortgage interest, state income taxes, etc., and your itemized deductions don't exceed your standard deduction, you're able to take the standard deduction on your U.S. income tax return. And if you take the standard deduction, then you can take an additional deduction of $300 if you're single, or $600 if you're married filing joint, if you've made cash contributions to charitable organizations. So it's a little bit additional benefit for people taking the standard deduction. Next slide, please. Now, for several years now, there have been proposals and even law changes that this medical expense itemized deduction that would be changing. Typically, in order to deduct any medical expenses as far as itemized deductions are concerned, what one has to do is you have to exceed those medical expenses by a certain percentage of your adjusted gross income. So if your adjusted gross income is $100,000, the floor where you have to exceed in order to take any of these medical expenses as itemized deductions is 7.5% of your adjusted gross income. You have to exceed 7.5% of your adjusted gross income. And the proposals and the law kept changing to try to make it to make the floor higher, to make it 10%, not 7.5%. And finally, the lawmakers decided we're going to permanently reduce the floor to 7.5%. It won't ever again. Maybe a future Congress will change this, but right now it's a permanent 7.5% deduction floor for medical expense deductions, where you have to exceed in order to claim them as an itemized deduction. Next slide, please. Now, if you are self-employed, and so obviously if you're working for the IDB, you're not self-employed, probably. You're probably viewed as an employee for the IDB. But if your spouse is working as a self-employed contractor or business owner, the law changed with regard to the deduction for meals. For many, many, many years, it's been limited for taking clients out to lunch, eating with your employees to talk about business. The deduction has been limited to 50%, but now the law changed to help, of course, restaurants during the pandemic. And for the next actually 2 years, 2021 and 2022, there's 100% deduction for business meals. Next slide, please. So with that, let's change our mindset a bit. And instead of talking about actual income taxes, we're going to talk about the paperwork requirements of the U.S. government when it comes to U.S. persons having to fill out foreign financial asset forms. So these forms that I'm about to talk about now don't cause a U.S. person to owe any additional income tax. Instead, they're income tax related in that you have to include them on your U.S. income tax return, but they're just information that the U.S. government wants to know. You see, for many years, U.S. citizens, green card holders, and people who had met the substantial presence test sometimes were trying to hide their income from the U.S. government, especially the foreign income. As I mentioned before, if you become a US person, your full worldwide income is subject to US taxation. And so, obviously, if you are in the US and you invest in stocks, bonds, and mutual funds, you will get 1099s. If you work for an employer, you'll get a W-2 form, etc. So there are ways and mechanisms in the United States for the US government to collect this information. But if you invest outside the United States, they don't have this particular requirement. So the US government decided to issue relatively recently, most of these forms are relatively recent, important financial forms that you have to file if you're a US person and you have certain foreign financial assets or you receive a gift or bequest from a foreign person. So we'll get into that now. Next slide, please. So let's talk about the Foreign Bank Account Report, the FBAR, Form 114. This actually doesn't go on your US income tax return. This is electronically filed, but the persons that have to file it are US citizens, green card holders, and US tax residents. If you have a financial interest or a signature authority over foreign financial accounts that in aggregate exceed $10,000 at any time during the year. So let's make sure that you understand that. If you have a foreign financial account, next slide, please. If you have a bank, a savings, a checking account, a securities account that has mutual funds, a brokerage account, even a foreign annuity or an insurance policy with a cash surrender value, if you have any of these things and in total your foreign financial assets exceed $10,000, you have to file the Form 114. It's electronically filed with an agency called FinCEN. You can Google it and see how to do this. It doesn't go with your US tax return, and you can actually be fined if you try to paper file it. You have to electronically file it. It's generally due on April 15th, just like the tax return. But again, it doesn't go with the tax return, but it's automatically extended until October 15th if you don't file by April 15th. Next slide, please. Next comes a specified foreign financial asset report. Again, these are all just administrative in nature. You won't have to pay any more income taxes because, as I said before, those of you who have US and foreign financial accounts and are earning income from both of those, you have to always report the income on your US tax return. These, again, are just foreign informational filings. So it's effective for individuals beginning in 2011. So there was no such thing before 2011. And this Form 8938 is included on an income tax return, unlike the Form 114 that we just mentioned, which is electronically filed separately. And that threshold for the 114, as I mentioned, was $10,000. That's because it's under the Bank Secrecy Act that was passed in the 1970s, and they never adjusted it for inflation. So it's a relatively low threshold where you have to file the FBAR, the Form 114. But for this 8938, if you're living in the United States and you're single, or you're married filing joint and you're living in the United States, then the threshold is $50,000 if you're single, or $100,000 if you're married filing joint. If you have specified foreign financial assets over these amounts, $50,000 or $100,000, then you have to file this report Form 8938, that goes with your income tax return. Next slide, please. Now, the Form 114 that requires you to file all these foreign financial assets is very similar in nature to what you have to report on this Form 8938. And you say, Dale, why do I have to report both? It doesn't make any sense to have to report both. I know it doesn't make any sense, but believe me, I won't go into the background. You have to report both if you meet the filing thresholds of both. So for this one, again, it's any foreign financial account made at a foreign financial institution. It's an interest in a foreign pension plan, and we'll get to that in a moment, but very similar to the Form 114. Next slide, please. So the IDB pension, if you are receiving an IDB pension, it definitely is considered a specified foreign financial asset for purposes of this Form 8938. And even though you may get a Form 1099-R from the IDB indicating the gross amount of the pension and the taxable portion of the pension, because it's a specified foreign financial asset, if you go over those threshold amounts, including your other specified foreign financial assets, because you have the IDB pension, you have to report the IDB pension on the 8938. Generally speaking, once you start receiving distributions from the IDB pension, you report the gross amount of the pension on the 8938, as well as your other specified foreign financial assets. Next slide, please. Now, another separate tax return, and I get these types of questions all the time about receiving gifts or bequests either from US persons or foreign persons. Let me just talk about that for a moment. Generally speaking, remember, there's always exceptions and exceptions to the exception, but generally speaking, if you receive a gift or inheritance, either from a US person or a foreign person, you won't have to pay any tax on that gift or inheritance. It's only the people who may give you the gift or inheritance. The estate may have to pay estate tax, maybe US estate tax, or the person giving you the gift may have to pay gift tax, but you receiving the gift or inheritance do not have to pay any tax. That's why this, again, is just informational in nature. But as we'll see here in a moment, if you don't file these informational filings, the penalties are extremely high. So gift or inheritance reporting on a Form 3520. So this gift or inheritance, you have to report any gifts or bequests, inheritances, that you receive if you are a US person and you're receiving over $100,000 equivalent in either cash or property of the gift or inheritance from a non-resident of the United States. So you may have a relative that lives outside the US who passes away and gives you a gift or inheritance, or I should say an inheritance of over $100,000, whether that's foreign property or US property or cash or whatever it is. As long as it's over $100,000, you have a reporting requirement on this Form 3520 Part 4. Again, you're not going to pay any income tax on the gift or inheritance. It's just that you have this reporting requirement. Next slide, please. So here's why you should care about this paperwork. Even though it's not charging you any additional amount when it comes to income tax, you may be subject to huge penalties for failure to file these forms. Generally speaking, it's all these forms have at least a $10,000 penalty associated with failure to file the form. So please do. Next slide, please. So once you've heard about all these things and you're a G4 thinking about becoming a US person, you may say, oh my goodness. And this is just, of course, the tip of the iceberg. I just was able to, if I had to teach everybody on this webinar the entire income tax system, it would literally take me years because it's so complicated. So this is just the tip of the iceberg when it comes to things that you should know that changed during 2020, and then also the important things about IDB employees, as well as you may be a US person receiving a foreign gift or inheritance. So the thing about the US tax system, it's not only complicated, but it has some traps in it. One of these traps is called the US exit tax. Next slide, please. If you are a US citizen or a green card holder who has held your green card for more than 7 years, and then you relinquish your US citizenship or your green card after having held it at least more than 7 years, and your net worth at the time of relinquishment of your citizenship or green card is more than $2 million, then you could become subject to the exit tax. And you probably think, oh, Dale, I don't even have close to $2 million. The present value of your IDB pension, the gross amount of the present value of your IDB pension, is included when testing for whether or not you have a net worth of over $2 million. So if you retire from the IDB at age 65, and let's say your mortality table says that you'll live another 20 years, and you receive a $100,000 pension from the IDB, well, 100,000 times 20 years is already 2 million. Okay, maybe it's a little bit less because of the present value, but most of my clients who may be subject to the exit tax are international organization employees who have to take into account the pension when it comes to the net worth tests. So it applies, and if you become a person who is subject to the exit tax, you are considered what's called a covered expatriate. And how does this exit tax work? The bottom line, I'll go right to the bottom line here, is most of the time the exit tax only affects people with an international organization pension and doesn't really affect the other types of income, or I should say gains, that they may have. So we're just going to concentrate on what this means for the exit tax. The IDB pension is a foreign financial asset that we mentioned, and it has to be reported if you're receiving distributions on the Form 8938. Now, this foreign financial asset, the law provides that if you receive a foreign pension and you trigger the exit tax, the entire present value of the taxable portion of your IDB pension would become immediately taxable. That is not good news. I very strongly doubt that the IDB would give you a tax reimbursement on the entire present value of the taxable portion of the IDB pension. Next slide, please. So again, who is a person that could be subject to the exit tax? It's U.S. citizens who relinquish U.S. citizenship, or green card holders who cease to be lawful permanent residents. And that would include people going, let's say you want to go from a green card back to a G4 visa holder. And I've had clients like this, but have held their green card for more than 7 years. If you relinquish it or go back to G4 status, that means that you take a look at whether or not you are a covered expatriate, which means that we look at whether you have a net worth of over $2 million. And there's also a tax test as well. Next slide, please. Now, most of my clients that potentially could trigger the exit tax fall under the 2 million net worth. Actually, there's a typo on this slide, just to point out. It's not actually average annual taxable income that we look at to determine whether or not you're subject to the exit tax. It's actually just average annual tax. But see, you would have to have an average annual tax of more than $171,000 to trigger the exit tax, or more than $2 million of net worth. So we have very few international organization employees that have an average tax, income tax, shown on their income tax return of more than $171,000. Instead, most of the people that may trigger the exit tax have a net worth of more than $2 million. Next slide, please. I just mentioned this fact that exit tax on deferred compensation, this is your IDB pension, so we can move on. It's treated as a foreign asset, and yes, we can move on. It's treated as a foreign asset, and so it's completely subject to 100% of the present value of the taxable portion would be subject to U.S. tax if you triggered the exit tax. So now there's another bad thing that happens with the exit tax is any person that triggers the exit tax becomes a covered expatriate, and obviously they've left the United States, they've given up their citizenship, they've given up their green card, but now if they were to pass away or give a gift to any of their children who are U.S. citizens, the U.S. citizen that's receiving the gift or bequest from the person that triggered the exit tax, the covered expatriate, will incur an inheritance or gift tax at the highest rate of 40% with no exclusions. So suffice it to say, do not trigger the exit tax if you can all help it. And if you ever were thinking about giving up your green card or US citizenship, that is one of the times you need to see a tax lawyer or myself to talk about how to get out and how to avoid the exit tax. Next slide, please. So I am an international tax consultant. I do planning. I help with tax returns. I do exit tax planning, retirement planning, and financial planning. So I work with a gentleman. His name is Jose Sobrado, and he has a registered investment advisory, and we work together on a day-to-day basis, helping international organization employees or retirees or their spouses, family members, with both financial assistance, with financial planning assistance, retirement planning, as well as income tax issues. So what I'd like to do is, next slide, please. What I'd like to do is I would like to offer a free 1/2 hour, what we call a financial health checkup. We can hear what you have with regard to your finances, and we can give you some tips specifically related to your financial planning, your IDB pension, which most people know is a net pension. And if you didn't know it was a net pension, what that means is that you will receive a tax reimbursement from the IDB, whether or not you have a tax payable in the United States or whether you leave the US and have a tax payable abroad, the IDB will reimburse you for any tax that's associated with your IDB pension. So we help people maneuver with regard to, there's a lot of things to consider if you're a G4 or green card holder or even a US citizen when it comes to retirement, especially from an international organization. We can help you with these things. And we would like to offer a free 1/2 hour meeting to the first 10 IDB Global Federal Credit Union members with Jose and I. So if you just send an email to dale@dalemasoncpa.com and just put in something like checkup to the subject line, and we would be happy to give you a free tax and financial health checkup at no charge to you. So that would be for the first 10 people that send me an email. dale@dalemasoncpa.com. So with that, I'm going to look at the Q&A. So for people that didn't have a chance yet to type their questions into the Q&A, now I'm never usually able to get to all of the Q&A in the time that we have, but I'll try to do my best to get through as many as possible. So let's see what we have here. I'm going to be looking at the Q&A now. Excuse me while I get my glasses on here. The first question, does a college student, a green card holder doing university study file for this income? 18-year-olds by the time filing is done. Thank you for your help. Okay. So the general rule is that if you're a US student and you may have some odd jobs or you may have a scholarship that applies to more than just the tuition and fees, but may actually give you a scholarship for room and board. And so some of that would be on the room and board scholarship, generally speaking, that's taxable and that's included in your income. So you don't generally, the general rule is that you don't have a tax filing requirement if your income is less than the standard deduction of $12,400. But if you can be claimed on somebody else's return, it gets a little bit more complex than that. So generally speaking, what I would advise people that are students, et cetera, you can actually usually you can use the free version of TurboTax, and it will walk you through your, summer jobs, your scholarships, your other income that you may receive. Maybe you have some interest income that you've earned. and it will tell you whether or not you have a filing requirement and the tax that it is due. Most of the time, when students or people that are earning a relatively small amount of income, what you want to do is you want to file a return so you get the withholding tax back. Most of the time, students and people earning very low amounts of income can get the withholding tax back, but you will have to file a U.S. tax return in order to get that withholding back. Can a G4 married to an American citizen be treated as a resident for tax purposes, 6013G election? Yes, that's absolutely right. So a G4 is generally speaking a non-resident of the US because they are a full-time employee of an international organization. Now, I should say that a primary G4 married to a G4 dependent cannot file as US tax residents. You're stuck filing as non-residents if you even have a tax filing requirement. However, if you're a G4 married to a US person, a US citizen, a green card holder, or somebody who's met the substantial presence test, then you can make what's called a 6013G election and file a joint income tax return with that US person. Now remember, in doing that, you will become a US tax resident, which will mean that your full worldwide income is subject to US tax. So you have to think twice if you're a G4 and you file with a US person, because if you have outside the country income, such as rents, or you may receive an inheritance in the future that may generate a lot of income, not the inheritance itself, but the underlying assets may generate a lot of income, then you may not want to make a 6013G election, because again, you will be filing jointly with a US person will cause you to have to report your full worldwide income, and most of the time have to report all these foreign financial asset reports. So you always need to consult with an international accountant such as myself or someone else that knows these things to see whether it makes sense, because once you file a 6013G election and file jointly, you'll be in that status. You'll file a joint return indefinitely until that election, that 6013G election, is revoked, and you can only revoke it one time. So just make sure you'd want to do that. Let's see what else we have here. Okay, let's see. Is there a statutory provision that precludes international organization workers from deducting SE health insurance and retirement contributions? It's not the fact that you are an international organization worker. It's the fact that you are an international organization employee. So if you are if you're a full-time IDB employee, you're eligible for all the full-time employee benefits, then you're definitely an employee of the IDB. And therefore, because you're an employee and not self-employed, you cannot take self-employment type of tax deductions. Now, the IRS is aware of these issues, and so I've had clients been audited in the past for trying to take self-employment type of tax deductions. Now, that's not to say that if you're a US person and you're working for the IDB as a contractor, then it gets to be a very difficult situation, because it's very hard to tell whether you're an employee or whether you're an independent contractor, basically like you have your own business. If you're working on a part-time basis for the IDB, it's clear that you're not an employee, you're not being directed and controlled by the IDB, then it is possible to be an independent contractor with the IDB, but you wouldn't get those types of employee benefits if you really are an independent contractor. And if you are an independent contractor, then you can take those type of self-employment tax deductions, including pension deductions, et cetera. But you have to be very careful about taking them and making sure that you really are an independent contractor and not an employee. Let's see. If I'm a green card holder working for the IDB, I am not subject to income tax. But if I retire from the IDB, then 183 days begin to run to estimate whether I am subject to income tax return. Okay, so green card holders are definitely tax residents of the US. Now, there's a specific provision in the Internal Revenue Code and the agreement that the US government has with the IDB that green card holders are not subject to tax on their compensation received from the IDB. It's just the compensation that's non-taxable. But when you retire, if you're a US person, you're always going to be subject to worldwide taxation, including any of the IDB pension that you receive. When I was talking previously about the 183-day rule, that only applies to non-US persons like G4s or people coming from out of the country, coming into the United States and spending more than 183 days in the US. It's those people I was talking about that go from non-resident to resident once they meet the 183 days. But you, as a green card holder, as your compensation wasn't taxable, but then when you become retired, you're still a green card holder, and therefore the pension that you receive is taxable regardless of whether you spend 183 days or 0 days in the United States. As long as you're a green card holder, you're a full year, you're going to be subject to full worldwide taxation, including the tax, US tax on your IDB pension. Yeah, so some people got the first stimulus check, but not the second stimulus check. That can be all rectified if you really are eligible for the stimulus check on a 2020 income tax return. So if you think that you're eligible and you're not a non-resident for 2020, then what you should do is file the 2020 tax return, and you'll get an economic income credit that you're able to take against your US taxable income that will effectively give you that second check that you were hoping to get. Let's see. I was a G4 until September 2019. From September 2019 to December 2020, I was adjusting my status and having income, unemployed. I became a green card holder. Should I file tax returns for 2020? So this is where the substantial presence test comes in. If you were a G4 visa holder working on a full-time basis for the IDB until September 2019, I assume that you were doing that for years and years, so 2018, 17, 16. Because you were a full-time employee, your time here in the United States did not count for purposes of the substantial presence test of residency, and not until you were probably retired from the IDB in September 2019, then your days didn't count up to September 2019, but then they started counting beginning on the date of retirement in September through December 31st of 2019. But because it didn't reach 183 days, therefore you're not a tax resident for 2019. But then you were in the US all of 2020 or most of 2020. So that means you have become a US tax resident for 2020 because you've gone over the 183 days, and therefore you have to pay tax based on your full worldwide income, including any IDB pension that you received in 2020. And so you should file a US tax return reporting that pension, as well as all your other income, no matter where you derived it. As a resident for tax purposes, if I pull from my retirement fund back in my country from before joining the bank, is that taxable? Yes, unfortunately, the way this works is once you become a US tax resident, it doesn't matter how much income that you built up in your foreign pension. It doesn't matter how much property that you own that increased in value. As soon as you become an income tax resident, the US has the right to tax your full worldwide income. So for example, in this gentleman's, I think it's a gentleman information that he gave, he has a foreign pension. Now that foreign pension, again, I didn't mention everything there was to know about the filing of financial forms. A foreign pension is considered a specified foreign financial asset for purposes of the Form 8938, as well as it might be considered what's called a grantor trust, in which case it may have to be reported on a 3520 as well. And it gets very complicated when we're talking about not only the taxation of foreign pensions, but also the reporting on these foreign financial asset reports. But the bottom line here is that you may even be subject to tax on that foreign pension, not only when you take a distribution from the foreign pension, but also the earnings within the foreign pension, even if you don't take a distribution. Because the US, under US law, that foreign pension almost assuredly does not qualify as a US qualified pension. So basically, it's ignored as a pension for US tax purposes. And so any earnings, any capital gains, any additions to that foreign pension, while you haven't even taken a distribution, may be subject to US income tax. Will IDB pensions be only partially taxable because contributions were not excluded from income? Yes, very good. So the IDB pension is a foreign pension. So if you're a G4 visa holder and you simply retire and leave the United States, that IDB pension, even though it was built up as you were working in the United States, because it's set up as a foreign pension, you won't be taxable as a G4 visa holder who was non-resident during your time here in the US working for the IDB, and then you decided to move abroad, and you will continue, obviously, to be a non-resident of the US. And non-residents of the US are not subject to tax on distributions from the IDB pension. So you won't even have to report the IDB pension on a US tax return if you were a non-resident in the US while you were earning it and you continue to be a non-resident in retirement. Now, this question with regard to yes, there will be a portion of the pension if you are a US person, a green card holder, or a US citizen receiving the IDB pension. A portion of that pension will not be taxable. And that portion of that pension, the non-taxable portion, will show up on the IDB IRS tax form that they send to the US government and you. Maybe you should have already received it if you've already been retired. It's called the Form 1099-R. They're going to tell you what the gross amount of the IDB pension is and the taxable portion. And what you'll notice almost in all circumstances, you'll have a difference, a much lower amount of taxable portion of the IDB pension rather than what the gross amount is. So your taxable portion is usually much lower than the gross amount. For US citizens working all of their career at the IDB, the taxable portion is lower, but not as low. The taxable portion is not as low as a green card holder or G4 visa holder working their entire career at the IDB. Let's see. I just want, in the few moments we have remaining here, there's probably there's too many questions for me to answer right now, but let me get to really important ones that may affect most people here. Okay, somebody is a retiree from the IDB and with a green card who's consulting on a short-term assignment, and do you need to be taxes on the service provided? This is a very good question. So the general answer is going to be this, that if you are an employee of the IDB and you are a green card holder, the wages as an employee of the IDB are not subject to tax. Now, how do you know whether or not you are an employee or an independent contractor? You're supposed to look at very subjective rules, whether you're directed and controlled, whether or not you use your own tools, whether you're at risk for a loss, all those things. But the easiest way to generally know is if you receive a tax form after year end from the IDB. I think the IDB issues 1099s to those people that are U.S. citizens or those people that they think are taxable on their earnings. If you receive a 1099 form, that means the IDB believes, even though you're a green card holder, the IDB believes you're a self-employed individual, and therefore you're taxable if you receive a 1099-R. Now, I know that most of the international organizations, including the IDB, understand that if they just treat the worker as an employee, that employee then will get tax-free compensation. And so most of the time in my experience, but this could change, in my experience, most of the time, green card holders working for the IDB will not receive a 1099. So it won't be taxable because the IDB understands that compensation to employees, not independent contractors, are tax-free. What is the threshold for US citizens on foreign financial assets if you live outside the United States? Now, many people probably have heard that US citizens that live outside the United States are eligible to receive this exclusion amount. It's actually called the foreign earned income exclusion. I want to emphasize the term earned, foreign earned income exclusion. So this foreign earned income exclusion is for US citizens living outside, living outside the United States that have earned income, which is wages or self-employment income. That can be excluded. It's over $100,000 for earned income if you meet the certain tests to meet the foreign earned income exclusion. However, it doesn't apply, this exclusion doesn't apply to investment income, and it doesn't apply to your pension income because that's not considered earned. That's considered passive, unearned income. So you get no exclusion for that. Again, if you are taxable on that investment income, passive income, pension in the foreign jurisdiction, then you'll get a foreign tax credit on your US tax return. Again, you have to report all of your income on a worldwide basis to the US, regardless of whether it's being taxed in the foreign country. And then you get foreign tax credits so you don't end up paying double tax. Yeah, this is an interesting question. A person is a green card holder, and they fill out all forms that I mentioned, including the FinCEN 114 and the 8938, and they report other income earned in the US. My question is, as an IDB employee, I don't even need to report my IDB income in 1040 as I don't get a W-2 form, correct? Yes, that's correct. So if you're a G4 visa holder or a green card holder whose wages are completely tax exempt because you're earning them from an international organization such as the IDB, then because they're completely tax exempt, you don't have to report them anywhere on the form 1040. You simply leave it blank, the wage line. Let me see if I can find one more question that might apply to a lot of people. Okay, this is the last thing to note. So remember, for green card holders, it's a very difficult situation if you're a green card holder receiving an international organization pension and you simply want to retire in your home country. You really have to think about whether or not you're going to trigger the exit tax, because as we mentioned before, the IDB pension is a foreign pension, and you may be subject to tax at a huge tax rate if you simply move abroad and give up your green card. Because remember, green card holders are considered lawful permanent residents of the US, lawful permanent residents of the US. And therefore, you can't simply remain outside the US indefinitely. So if you ever have to give up your green card because you want to live abroad in your retirement years, then if you go over the 7 years of holding your green card before you give it up, you really have to be careful. Now, the other option, of course, is, of course, you'd need to speak to an immigration lawyer, is to, if it looks like you're going to trigger the exit tax because you want to move back to your home country, you may need to get US citizenship, because obviously as a US citizen, you can just live abroad forever and you'll never get your US citizenship taken away from you. So it's important that you calculate these things in advance of either getting the green card or once you are thinking that you may go over 7 years of having the green card. So with that, I just wanted to remind everybody, thank you so much for the credit union sponsoring this event. This has been great. And I just wanted to remind everybody that we will be expanding. I think we're going to probably expand, depending on what type of how many people we actually get taking advantage of the free 1/2 hour financial health checkup. So again, if you want a financial health checkup for no charge with Jose Sobrato and I, who's a financial advisor, just write to my email address and put in the subject line checkup. So write to Dale, D-A-L-E, at dalemasoncpa.com. So it's Dale, D-A-L-E, at DALEMASONCPA.com. And with that, I'll turn it back to Marilyn. Thank you so much, everybody.
Thank you, Dale. There was so much amazing information. And obviously, a lot of people are interested and you're helping a lot of people. So thank you very much. I wanted to remind everybody that this webinar is being recorded and all registrants and attendees will receive the recording as well as the presentation material via email. And additionally, your feedback is very, very important to us. So after this event, you will be receiving an email asking to rate the presentation, rate the overall content, etc. And also, I'm going to put it in the chat so that everybody knows to please take that email take that survey as soon as you can. And don't forget, we have a lot of these amazing webinars throughout the year. If you go to idbglobalfcu.org under resources section, you'll be able to see all the different topics that we'll be hosting this year. I want to thank everybody, thank the team for helping us put together this event, and thank you all for attending. I hope you have a wonderful day. Take care and be safe.
Thanks, everybody.